Hi, I'm Dave.
And I'm Paul.
And we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go.
All right. Well, good afternoon, Dave. Good to see you again.
Yeah, welcome back. Here we go again. All right. Well, we could chit chat for a while, but I was thinking, why don't we just get into it? Because we got some good stuff to cover today.
Yeah, let's do it. What are we talking about today? Yeah.
We are going to talk about some personal examples. So we've covered some mechanics of infinite banking, the structure of the policies and how it all works, that flow of money, leveraging the capital. We've talked the pros and cons in the last episode. Now, today I was thinking, why don't we cover some personal examples of how have we actually utilized this in our own lives, or maybe you have an example from a client that's a really good one to share, because I know we both have tons from our own experience and from the experience of our clients who've gotten involved in the private lending and syndications and that kind of stuff, utilizing cash value loans. So how's that sound?
Yeah, that sounds great. I think, I think people, once they understand the concept, they kind of, all right, now what? What do I do with this savings that I have, this contractual access to capital? What do I do? And of course, the simple answer is whatever you want. But here's some practical application or some real world examples of how Dave and I have leveraged this asset to our advantage. Yep,
great. That sounds good. Well, I'll start. So my journey with infinite banking started in 2010. So a good friend who I'd known for about 10 or 12 years at that point, brought it to me, told me to read Nelson's book. He had started a business around that a couple years prior. And so I read the book, had a lot of back and forth dialogue with him until it clicked. I'm a slow learner. Finally, the light bulb went off and it clicked, and I started shoveling as much capital as I could into some policies that I set up for everybody in my family. So from 2010 to 2016, I didn't really utilize it as anything other than a savings account, which if you do nothing else, then nothing other than just creating a savings account in a different place inside a policy, as opposed to in your checking or savings account at your bank, it's still phenomenal, right? But what I did in 2016, that's when I decided I needed to get out of my corporate America job and get into real estate investing. So I bought my first house to flip in 2016. I think I closed on that in May, and I estimated, from all my vast knowledge and experience in flipping houses, that it would take me 2 months, right? 2-month project, in and out, will make 20 grand, which I'd be completely happy with on my first flip. Well, 2 months turned into 9 months and ended up losing $11,000 when all was said and done. But the education I got from that $11,000 investment, I'll consider that an investment in myself, was more than I could have ever paid for from anybody to teach me anything. Even though I did pay to be in a coaching group as well. So I was in a coaching group, but I still made every mistake they told me I would make if I didn't follow their advice. I decided not to follow all of their advice, and I made every mistake you could. So how that happened, we bought the house, found a contractor on Craigslist. It's always a great place to find a contractor, right? Gave him a pretty hefty down payment. Mistake number 2. Actually, mistake number 3. And mistake number 1 was buying the house at the price I did. You make your money when you buy. I bought it too high to actually make any money off of it in the first place. So it was doomed from the beginning. But again, education process. Found the contractor after like 2 months of him doing almost nothing and every week telling me it's going to look like a different house by the end of next week, and me continuing to believe him, I finally wised up and fired him. I had to threaten to sue him to get my money back, the money he hadn't spent already, and then had to go search for a new contractor. So I say all that just to say that I was pretty dumb and green. I had no idea what I was doing. I thought I had a better idea than what I did, but I jumped in anyway. Action trumps inaction. Even if you lose money, you're going to learn something. So the good news is I never lost money on another flip after that. Always made money. But how does this involve infinite banking? Well, by 2016, I had over 6 figures of cash value saved up. And it was actually part of my plan. I decided, hey, before I quit my corporate job, which I was making very good money, 6 figures with bonus and vacation and benefits. Before I quit this job, I need to have $125,000 in cash value. So I did that. I kept working until I had 125 grand in cash value. And I said, okay, that's enough for me to fall back on for the next year and a half if I make no money whatsoever in the real estate investment business. So I did that, bought a house, was flipping that house while I was still working my W-2 job. So I used a bank loan or a hard money lender to purchase the house. But for the rehab, which ended up costing about $50,000, was supposed to be about 20, turned into 50. I'm sorry, it's supposed to be 30, turned into 50, right? Another big mistake, underestimating the rehab cost. To fund that rehab, instead of going to a bank or a hard money lender for another loan, I instead said, well, shoot, I have all this cash value saved up. I'm going to utilize that and actually put this into practice. Instead of using it as a savings account, let's use it and see what that actually looks like. So I did that, took that $50,000 loan out. And because I own the policies personally, I took a loan against my cash value. And then I took that money and I loaned it to my company, my LLC. And I charged my company 10% interest to borrow that money from me. So that covered the interest I have to pay back the insurance company, and it provided some interest income for me personally, and it's a write-off for the company. So I loaned the money to the company. The company spent it on the rehab, and had I not used that, had I gone the route of a hard money lender or a bank, what are they going to require from me every single month as terms for that loan? A loan repayment. Right? Well, I wasn't making any money. I didn't have the money to repay a monthly note. And the great thing about it is, I borrowed this money from the insurance company. They weren't calling me during dinner saying, hey, where's our money? Where's the payment? You need to make a payment. They weren't knocking on my door. They weren't sending emails or letters in the mail. They didn't care because the repayment structure was completely up to me. So talk about taking pressure off. At least I didn't have to make that payment every month, right? While this project extended from 2 months to 3 to 4 to 5 to 9 until I finally sold that house. So how did I repay that loan? I just waited until I sold the house. When I sold the house, I got all of that cash back, right? And, minus the, $11,000 that I ended up losing. But I just took the big chunk of money that I got back and I just repaid the loan with it in one fell swoop. So, I didn't have to make a monthly payment. I wasn't stressed about making that payment because I knew I would get it back when I sold the house. And when I paid it back, guess what? It was available for me to use immediately on the very next flip. I could have bought a house the next day and started a rehab on that. I had that cash available because I paid it back, replenished my line of credit, and then I could borrow against my cash value again very quickly to go do the next project, which I did. Successfully use those loans to fund multiple rehabs over the next couple years. So that was really my first foray into actually utilizing and seeing the power and the benefits of what I had built up over that first 6 years. Now, that certainly doesn't mean you have to wait 6 years to use that. Right? I think you and I both have clients, and you did this yourself, is you pile a bunch of cash in there right away. And then immediately within, for some clients I have immediately within the first month, they're leveraging their cash value for a loan to go purchase the next real estate deal or to fund an ongoing rehab or something like that. So you can let it build up, or if you have plans to use that right away, then you kind of reverse engineer, say, I need this much cash value available. So let's figure out how much we need to put in year one so I can start utilizing this as my financing source. So that's my story.
I tell you, it's powerful, Dave, when you consider just the control you had and the power of not having to make a payment and the kind of the lack of stress. I mean, it's still a stressful situation anyway, just because, things didn't go the way you had planned. Although you did learn a lot. Obviously, we learn a lot from our mistakes that we make. We always hear like these hard and fast rules. Like if you do this, you'll be all right, and then we ignore them. And I've done the same thing.
Yep. And
it's super annoying when you look back. However, having that contractual access to capital. And folks, what he's talking about is like there's no repayment schedule when you take a policy loan out. Should you replenish your capital? Yes, but it's on your own timeline. So like Dave just said, sold, got done rehabbing the place, sold the asset, and then replenished that policy loan. So that's the perfect use, control, liquidity, use of the money, and no repayment schedule. Just phenomenal. So that's one thing I talk about with my clients and especially new clients all the time, because that's a question that always comes up. They're surprised. They're like, you're saying I can take, a policy loan from the life insurance company using my cash value as collateral? Yes, you can. And then I don't have to pay it back on any kind of timeline, like amortized schedule? I said, no, you don't. So depending on what you're doing, right? I do some private lending, Dave, that are balloon payments. Not too many, but onesies and twosies just for repeat customers. If they ask for, just a lump sum with a 6 or 12 month note, and at the end they make a balloon payment with the interest payment, I'll allow that. But in the meantime, I'm generally flowing other cash flows against that policy loan anyway, so it doesn't really matter. But again, there's no pressure. Like I know the money's going to come back one way or another, and they're not beating me up the company's not beating me up to make a policy loan repayment. But make no mistake, folks, right. Replenishing.
Yeah. If I had, talking about access to that capital, if I had not quit my 401k when I did, or let's just say I was a traditional American out there and I had put all of my money, instead of capitalizing my own banking system, I was just funneling my capital into a 401k, into an IRA, some qualified plan. I would not have been able to take that loan, most likely, to go do that rehab, right? So I would have been forced to go to a bank, go to a hard money lender, and pay exorbitant interest and required monthly repayments on that loan to perform that rehab. But my capital was accessible. It was liquid. And that's the only reason I was able to do that.
Yeah, I see a lot of people on some of these Facebook groups that we're in talking about, doing a TSP loan. And yes, the thrift savings plan allows you to do that. You can take up to 50% of your account value or $50,000, right? But no more than $50,000 in a loan. But now you have a 5-year repayment schedule, and as low as those interest rates are on those loans, the amortized payment is humongous. So as far from a cash flow perspective, from a monthly cash flow perspective, it's a killer, regardless of the interest rates 0.75 or 1.6 or whatever they are today. They're fairly low. The amortized payment is going to take a large chunk of your cash flow to satisfy that loan, and you don't have a choice. It comes right out of your LES. You can look at it every month, and that money's going away. So there's definitely a better way. And I'm in the same boat, Dave. I quit my TSP contributions back in early 2020. It was actually a coworker of mine that was like, why do you keep dumping money in there? And you said the same thing to me, and I've been doing it for so long. It's tough to change that mindset. As much as I thought about infinite banking and knew about it, and or at least thought I did, understanding everything, what's going on in the financial world, but I've since quit those. I don't make any qualified plan contributions anymore. And all those cash flows now that were going into the thrift savings plan or IRAs are now going into life insurance premium across six different policies.
And to be clear, we're not advising people on what to or what not to do with their qualified plan, contributions, distributions, whatever. That's not our role. We're simply stating what we've done and relaying stories of what our clients have done. If you want to continue to contribute to those plans, great. You can still do that. But you'll be better off if you do this in addition to that.
Absolutely. It gets back to that. This is an and asset, not just a this or that. It's both. It's a both strategy. And again, like Dave said, do what you want. We're just telling you what we've done. So this might be a good time to talk about maybe a client story. And I'd like to have her as a guest maybe at some point. We'll start to have some guests on eventually, but there's so many stories of clients that they do have money in qualified plans, and these happen to be civilian clients, and their employers did not allow them to access their money, regardless of what was going on with the CARES Act, regardless of what's going on. While they were still employed, they weren't able to access their money, which is troubling, right? It's literally your money that you're trying to do the right thing and save for the passive income time, or retirement, as most people call it. We'll call it passive income time. But I do have a client who I reconnected with from childhood. I've known her since I was probably 9 or 10 up in Massachusetts, and one day I just happened to be sitting on the bed, scrolling through Facebook, not being productive at all. And I saw a Facebook post of hers saying, "Hey, we're thinking about getting a financial advisor. Does anyone have any experience in this? What advice, or who's your guy, or whatever?" So I think I sent her a private message on Facebook and said, "Hey, why don't we connect? And I've got some experience in this. I'm in the space." So she did. We probably talked for an hour, and I told her about Nelson Nash, infinite banking, dividend paying whole life insurance, prioritizing your own capital accumulation, using IBC as a debt repayment, incorporating IBC as a debt repayment strategy. So leap of faith she took, pretty big. She did everything I told her to do, or I asked her to do. I said, "You need to read this book. You need to read this book. I need all your financials, et cetera, et cetera, et cetera." And within a week, she had read Becoming Your Own Banker. She had read The Case for IBC. She had packaged all of their financials and overnighted them to me. I had never had a client do this, like in that short order. It was really amazing, and you can tell that this person wanted to be free of, and I'll go into kind of her story a little bit of what was going on in their lives. Both her and her husband had gone through some troubles in their previous relationships. They both had children. Now both had good incomes, but were servicing 10 different credit cards, servicing some debts. The average, the credit card interest rates were anywhere from 18 to 26%. So I think they were averaging around 20 to, it was terrible. And they were making like extra payments on some of them. And so what I did was, after finding out everything financially, they did have some money in some qualified plans that their employer would allow them to get at, luckily. And I said, "Hey, did you know, because of the CARES Act, with hardships and stuff that you guys have definitely faced, that you can access this money penalty free?" So what we did was I structured a policy where they could take that money, take it out of that penalty free, and they literally closed the account. They took all of it out. They were able to do a single lump sum premium, And then we did some budgeting and some stuff. I was like, you don't need a $600 a month, personal trainer and all this other stuff. It was crazy. We went into their insurance premiums as far as car insurance. I was like, you can adjust some things here and there's some cash savings there. So we structured a policy where she can get as much cash into it as possible, solved her need for death benefit because they do have several children. They're both breadwinners. And she then took, once the policy funded, she then took a policy loan or a series of policy loans and started doing kind of like I hate to say this, but the Dave Ramsey debt snowball method and knocking out those debts, the bad debts, one at a time. Mm-hmm. Or several at a time. Within 6 months, the credit card debt was gone. They had some pretty high interest rate auto loans just because their credit was bad because of all the debt. So their credit scores jumped from like the high 500s, low 600s into the mid 700s, low 700s. They were able to restructure their two vehicle loans from, I think one of them was 12%. So they were really looked at as like some subprime borrowers at the time. And they were able to refinance into normal, 2.9%, 3.9% auto loans, which increased their monthly cash flow even more. So we were able to free up a few $1,000s of cash flow just by restructuring the debt. And they have now since able to get a HELOC on their home, which they use to rehab. They're paying back their policy loans. They're making their premium payment every month. And at the end of this, another about 6 months, they'll have the HELOC paid off and they'll have their policy loan paid off with that ever increasing contractual cash value. So she's been a great referral source for me. She's like so thankful. And it's one of those satisfying cases where I was able to literally change the financial trajectory of their lives. And, kudos to them. They took a leap of faith in me, some goofy kid that she knew when I was, 9 or 10 years old. And we haven't seen each other in, 20 something years. Cause I moved away out of that town and joined the military and stuff. So I haven't physically seen them in so long, but it was a great leap of faith and just a great story. And it's totally changed their lives. And I couldn't be happier for them. And what, what's coming for them next. They're looking at a vacation home in Maine to buy now. And it's awesome.
That's awesome. That's great. Because, they had a problem. They were looking for a solution. And good for them reaching out to the Facebook world and their network saying, does anybody know anybody who could help us? I think that's the first step is being brave enough to ask that question or even pose that question to yourself. Hey, is there a better way to go about doing what I'm already doing? And in their case, yeah, there are many different ways. I mean, you set up policies for them, but it didn't stop there. It was kind of more of a holistic approach to eliminating debt and setting them on a trajectory that's going to, set them up for success in the near future, and then for generations to come. Right. So it sounds like a really ideal client, somebody who, and especially the part you said about them digging into those books so quickly, reading, researching, taking the responsibility upon themselves and not just being spoon fed. Because if people want to be spoon fed, there's thousands of people that will go take your money for you and invest it. And you can abdicate control of your finances to anybody. You can, probably throw a stone from your house and hit 5 CFPs who will be more than happy to take your money, put it in the market, and then blame the market if you lose it. So, just being brave enough to ask that question and reach out and explore something that was completely unknown to her at the time, I'm sure, right?
Absolutely. She's a nurse. She actually went to the same nursing school that my mom did outside of Boston. What I've been finding with several nurse clients, nurses seem to pick up this stuff pretty easily for some reason. I don't know why. They're bright people. But I had never seen anyone want out of a situation so bad that they literally did everything I asked in short order. It was it was amazing. It was like a breath of fresh air. Because that, you know, I mean, you're in this business. That's rare for someone to kind of, yep, I read the book. I read this book, and I'm ready to chat about it. Like, phenomenal.
Yeah, but it's what we expect. I mean, if we're going to work with somebody, we're not going to explain that book to them start to finish. We are going to give people an idea of what this is about, and then give them homework. This is becoming your own banker, not finding somebody else to be my banker.
Right.
Right. It's all about personal responsibility, taking control, and putting yourself in the driver's seat of your own financial, your own financial future and the vector that you want to head. So that's what we're looking for: people who want to help themselves and are willing to do so. Yeah,
I appreciated most of all that she valued my time. And didn't want to waste my time. So I appreciated that, just from a personal note, because our time is precious, right? For sure. But yeah, great client, great story. Definitely like to have her on at some point just to talk about it. She definitely, she's already agreed to it, I think. So, just a great story.
Okay, good. Yeah. And we've got many more of those. So I think we'll sprinkle those throughout these episodes. Case study after case study, maybe the next one we'll talk about the guy that we're in business with right now who started a dump truck company. Who would have thought that a dump truck company is something somebody actually wanted to start and enjoy and crushing it, but he had to come to us because, even with, making $400,000 a year or something like that, the bank didn't want to give him a loan to buy a truck.
Yeah, Dave, he went to, he went to like 6 different banks. And, this is a guy with, good credit, literally no debt except a mortgage. Like the ideal person to loan money to. He doesn't necessarily need the money, but a guy that's got a lot of money tied up in a 401k that he cannot get at. Cannot get at.
Yep. Right. Yeah. Well, and banks aren't making the loan necessarily against your business plan or your business idea or the asset that you're going to go purchase. They're making a loan based on their confidence that you can repay that loan every month. So if they think that that's too much risk for them, they're going to, it's easy for them to say no because they do not have a lack of opportunities coming their way, right? I think we can all agree that banks have more opportunities than they need. And that's kind of the position that we're in now, where we got plenty of opportunities. Anytime I have a chunk of cash that I'm ready to take a loan against, I just reach out to you, Paul. Hey, Paul, what do you got on the line right now? What do you need? You got anybody who's looking for a loan? And we set it up and we go. So yeah, the possibilities are endless, and it's just a really fun position to be in. So yeah, great, good stories, man.
No, I love it. It's amazing when you just start thinking like a bank, as opposed to a borrower. When you start thinking like a bank and replicating at your own level, the you and me level, as Nash said, what banks do. Like you said, that the possibilities are endless and the opportunities are literally endless, whether it's opportunities you create yourself, you see that duplex or that fourplex down the street or whatever, or it's a private loan, or it's a syndication, or it's a joint venture, whatever, or it's a new Ram truck, whatever it is. When you start thinking like that bank, it's life-changing. So
yep.
I think that's
sure is. Yep.
What do you think? Good way to wrap it up?
Yeah, I think so. We got plenty more we can talk about, but we'll save that for the next episodes. So
right on.
All right, man. Hey, good conversation. Good to see you. And look forward to talking again.
Can you tell I moved the bookcase?
Yeah, look at that. Is that a virtual background, or do you actually read all those books?
Tammy's read like 1 or 2 of them, I think, but the rest are mine.
Yeah. I think you and I have a lot of the same reading list.
Yeah, there's some von Clausewitz on there, and there's some I'll have a lot of financial books up. I've near the picture of Carmela when she was a baby, but yeah, absolutely. Definitely not a virtual background.
Information. Yeah. Well, good for you. You're a smart guy. Forget what everybody else says, Paul.
I know. Well, I just try to hang out with smart people.
Yeah, you and I both.
Cool.
All right, my friend. Well, hey, good talking to you. We'll catch you again next time.
All right, buddy.
All right, see you.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.